Maybe stop worrying every time the rent hit his bank account. So he started trading. At first, it felt exciting. He'd sit on the subway refreshing charts. At lunch, he'd watch price action instead of eating in peace. Late at night, he'd stare at candlesticks glowing on his phone in the dark like they were trying to tell him something important. Trading gave him adrenaline. He wasn't buying businesses because he believed in what they might become over the next 10 years. I'm buying because the price might move in the next 10 minutes, or the next 10 days, so my attention shifts. Now, checking patterns, momentum, headlines, and catalysts. Patterns, breakouts, momentum, headlines, catalysts, volume, timing, a few clicks, a quick gain, and suddenly the day feels different. Trading is incredibly hard. Not fake hard, not internet hard. Smarter, sharper, more in control. That's the seduction of trading. It's active, it's intense, it feels like skill. Trading is incredibly hard. Not fake hard, not internet hard. And in a city like New York, loud, competitive, always moving, that kind of fast-paced environment can feel strangely natural. But here's what John eventually learned. Trading is incredibly hard. Not fake hard, not internet hard, actually hard. Because what looked simple on social media felt very different when it was his money on the line. When the market moved against him, it wasn't just numbers on a screen. It was stress, doubt, frustration, second-guessing, the urge to win it back. The market didn't care how badly I wanted a trade to work. It didn't care that I had done research for 2 hours. It didn't care that a setup looked perfect. It didn't care that he needed this one to go green. And every mistake had a cost in terms of fees, slippage, taxes, bad entries, selling too early, holding too long, trading out of boredom. I traded out of ego, just to feel like I was doing something. And it all added up faster than I expected. What if the problem wasn't that I needed to trade better? What if the problem was that I was playing the wrong game? Because that's the uncomfortable truth. For most people, trading is not a reliable wealth-building plan. It's short-term speculation wearing the costume of sophistication. Then something changed. One evening after a long day, John was sitting in his apartment, tired of the noise, tired of the stress, tired of pretending every trade was part of some master plan. What if the problem wasn't that I needed to trade better? What if the problem was that I was playing the wrong game? That's when he began to understand something important. Investing is not just a slower version of trading, it's a completely different mindset. Because investing isn't about trying to profit from short-term price swings. It's about owning assets that can grow in value over time. Real businesses, with products, customers, profits, and cash flow, the ability to expand over years and decades. So instead of asking, what will this stock do next week? Ask about the business. What is this business actually worth? Is it durable? Is it growing? Does management real problem this? Would I still want to close for a year? Those questions changed everything. Because now he wasn't trying to predict the crowd, he was trying to own value. And that's the real difference between trading and investing. Trading tries to capture motion. Investing tries to capture growth. Trading lives in the next hour. Investing lives in the next decade. Trading depends on precision, timing, and emotional control under pressure. Investing depends on patience, discipline, and letting strong businesses do the work. I started to realize that real investing is powered by 3 things: time, compounding, and business growth. These are the keys to success. Time gives great businesses room to execute. Compounding allows your returns to start generating returns of their own. And business growth is what drives real long-term value, not hype, not noise, not random price action. At first, it felt boring. There were no dramatic alerts, no emotional highs, no rush from being right in the next 15 minutes. But that boring feeling was actually a sign that something healthier was happening. For the first time, John wasn't glued to every move. He didn't need to react to every headline. He didn't need to stare at the market like it owed him something. He could go to work, see friends, walk through the city, live his life, and while he lived, His money could stay invested in businesses and broad funds designed to grow over time. That's when he understood something most people learn too late. The stock market rewards patience far more often than it rewards excitement. So why should most people avoid the rush? Because the odds are stacked against them. Trading rewards precision, speed, discipline, and emotional detachment. Most people bring the exact opposite. They chase what's already moving. They panic when prices fall. They get greedy when prices rise. They mistake luck for skill. And they trade more when they should step back. That's not because people are stupid. It's because people are human. And trading punishes human nature. By the end of 2023, John Doe hadn't become an overnight success. Clarity. Investing, on the other hand, works with one of the average person's greatest advantages: time.
You do not need to predict every rally, every dip, or every breaking headline flashing across your phone while you're standing on a crowded platform at Times Square.
You need to stay consistent. You need to keep costs low. You need to stay diversified. And above all, you need to avoid making emotional decisions when things get noisy. That's the real edge. Not brilliance, not secret indicators, not perfect timing. Patience. Because over the long run, businesses grow, economies expand, innovation continues, profits compound. So instead of trying to win every ripple, most people are better off riding the larger wave. That may not feel exciting, but exciting and effective are not the same thing. And when your future is on the line, effective matters more. By the end of 2023, I hadn't become an overnight success. I hadn't found a magic stock. I hadn't cracked some secret system. What I found was something better: clarity. He realized that if he truly wanted to build wealth, he didn't need more adrenaline. He needed a better framework. He needed to stop treating the market like a slot machine and start treating it like ownership. So he changed course. He focused on building a diversified portfolio of strong businesses and low-cost index funds. He added money and stayed in the game. And little by little, he began doing what most flashy traders never do. He started building something durable. Now look, if you have the time, the temperament, the risk controls, and a genuinely proven ability to trade successfully, that's a different conversation. But for the vast majority of people, the smarter move is to invest, not trade. Because the rush of trading feels good for a moment. But building real wealth feels better for a lifetime.
And John Doe learned that in New York, in 2023, not by watching someone else's highlight reel, but by living through the cost of confusion himself.
So if you want to stop gambling with your future and start thinking like an owner, hit like, subscribe, and let me know in the comments. Are you a trader or an investor? And what are you planning for the coming month? Hit in the comments section. I'll see you in the next one. In 2023, John Doe lived in New York. He saw ads promising get rich quick, but trading is risky. Most people lose money rushing in. Avoid the rush. Learn, plan, and invest for the future.